What's going on, everybody? Hope you are well. Lawrence here, of course, with the Thursday evening peer-to-peer lending financial thing live stream. This is going to be the last live stream of 2022, so I'm very, very excited. I'm pumped up to be here with you tonight. We have some really interesting stuff to get through. What are we going to be looking at today? We're going to obviously be looking at the big news. Breaking news, Assetz Capital is going to be running down their loan book and closing their doors, bang, to peer-to-peer retail lending to go down the institution funding route. We have seen this happen again and again with these companies that scale. They just get so big and they find that the peer-to-peer lending space retail side, which is you and I, retail investors, is just too small to get the job done. So we're going to talk about that. We're going to talk about Assetz Exchange, how that is going to affect them. We're going to talk about the inflation numbers that came out and the interest rate raises that are coming in England. It already happened. It happened in the US. Probably going to see it continue into 2023, how that's going to affect the economy. And we're going to go through some of the peer-to-peer lending interviews that I've done over the last year and just kind of go through a couple of snippets of, in case you haven't seen all of the Q&As that we've done with people like Louis from LoanPad, Assetz Capital, Stuart Law, Axia Funders, Cormac Leach. We got a whole different bunch of Q&A sessions that have happened. So if you haven't seen them all, go back and look in the archives. Are really interesting. But we're going to just look at a couple of snippets from some of those interviews over the last year that I found to be really insightful and interesting. Check those out. Kind of give you a little bit of feedback about what I think. But firstly, if you can, just do me a favor. Please hit that thumbs up button. It just takes a second. I'm not going to tell you why. You know why. And thank you again to everybody that's been watching throughout the year, supported this channel. You know, I'm just a one-man team, small channel, very niche, but I can't do this without your help, your support, your eyes, being on the videos every week, checking out the channel, checking out the website. You know, it's going to be a tough 2023 economically. I believe it's going to be a tough year for financial thing as a business, so I do rely on your support. And it means a great deal to me that you continue to show up here every week. You know, we're not a big channel. I'm not a big channel. I don't have 100,000 subscribers or 1 million subs. So every little bit helps. You know, thank you so much to all the Patreon members. The dog is telling me she wants to get up. Hold on. Thank you to the Patreon members out there who have joined up and, you know, continued that support in whatever form that is for you. I just really appreciate it. And I never thought that this channel would be continuing to grow and be supported in this way, so I owe everything to you guys, and I mean that from the bottom of my heart. I really do. So I hope you enjoy the content. I try to do my best to give you interesting content every week, and we'll continue to do that into 2023 as I take a holiday, much needed, coming up soon. I'll be coming over to Blighty, obviously, probably visiting Paris for a couple of days, going to see my 86-year-old mother for a while, spend some time with her. And yeah, that's going to be it. It's going to be purely R&R, recreational trip. No business meetings or anything like that. I just need a bit of time off. So I may possibly be back on New Year's Day of 2023. I don't know for sure. It depends how tired I am. We'll see what happens. But if not, this will be definitely the last stream of 2022. So I'm glad that you guys are here, and girls, guys and girls. I know there are some women here that watch this channel. So anyway, let's get started. And what time is it? 2:30. Okay, 7:35 p.m. UK time. Norman is here, of course. He says there is snow on the ground in Sussex. Hoping to avoid that, but I'll tell you what, I'd rather have some snow than rain. I have a feeling that when I get to the UK, it's going to be raining. So as it is, can't control the weather. Colin Perry is here in the Peak District. Paul Bagworth from a very cold Kenilworth. Dave Allard from the Midlands. Robert Pates From a cold horn church, Peter Clark is in Huntingdonshire. Peter Leatherhead, of course. I said Peter Leatherhead, Peter Vince in Leatherhead, Paul New in Stockport, Akichap in a very bloody freezing bloody freezing Accrington. Mike Powell said, Mike Powell is here. I was just reading his comment for Southampton. Thank you to anybody also that signed up to the sign up cashback links that are on the Financial Thing page. Those are going to be ending in January, so you do have a little bit of time to get in on some of those promotions, but most of them are gone now anyway. So John Day is here in Nottingham. Annabelle Nyron still in Spain till Saturday, flying to the UK for Christmas. Hey, that's not a bad place to be for Christmas. Wayne Bernard in a chilly Kent. And Harley is Peter's asking, is Harley the dog coming with me? No, she is not coming with me. She has a very good babysitter, and she'll be well taken care of. Hopefully, maybe she'll get a bit of Christmas dinner. We shall see. Anyway, let's get into a couple of pieces of news. We don't really do too much news today. There was an interesting article on peer-to-peer financing news that said, let's show you this. Industry outlook. What does next year hold for peer-to-peer lending? And some of the chiefs of these companies put in their input. Stuart Law said peer-to-peer property-backed lending in 2023 remains, in our view, the strongest sector of the peer-to-peer lending industry. Of course, we got this news now that Assetz is going to be closing their doors to retail lending. We're going to go through that too. Jatin Ondia, he's the CEO over at Shojin. He said in strong locations, demand still far outstrips supply. That would be for housing, and this will support housing prices. There's still obviously a big shortage of housing in the UK. Times of uncertainty bring opportunity. I'd certainly guarantee that is the case. We're seeing that in the stock market right now. A lot of uncertainty, a lot of issues going on with companies and profitability. In theory, therefore, investors should go into 2023 looking to invest in peer-to-peer lending loans and real estate. As we've seen in the past, real estate does very well coming out of a downturn, so investors should still include a property allocation in their portfolio. Yes, there will be headwinds, but most real estate projects are around 24 months, so the market should have recovered by the time the investments mature. We expect to see good exits from projects starting next year in 2023. Brian Barterby, CEO of PropLend. Commercial property is dealing with a combination of a rapid rise in the cost of debt and inflation, together with the ongoing long-term structural shifts in demand precipitated by the pandemic. A recent RIC survey saw occupiers' inquiries fall from retail and grow modestly for offices, and industrial demand has remained strong. I was not really talking too much about peer-to-peer lending here, but more about the general status of what is expected in the property market for 2023. We've got Cormac Leach, CEO of Axia Funding, saying in 2023, I would expect to see inflation almost as high as this year, but with much lower growth. A case of bad stagflation last seen in the 1970s. If history is any guide, equity markets will be on a significant decline. By the end of 2023, I'd expect Bank of England to cut interest rates. If this outlet is correct, property markets will see double-digit declines. And then Paul Sonner-Bend, executive chairman of Relendex. The fundamentals of the UK housing market is unchanged. There is a chronic housing shortage. We have a growing population, and house builders are unable to keep up with demand. Mike Carter, head of platform lending at 36H Group. The outlet for 2023 is dominated by recession, with inflation and base rates forecast to peak over the next 12 months. This is also an opportunity for the sector to demonstrate, in the peer-to-peer lending sector, its commitment to customers, both in terms of continuing to provide credit sensibly where others have pulled back, and to help customers manage their loan commitments where the recession causes small and medium-sized enterprises and consumers to have cash flow problems. If any of these comments, I would certainly think the one that resonates with me the most is this one by Cormac Leach, saying a bad case of stagflation. I think this is exactly what we're going to see in 2023. I think we're going to see these interest rates continuing to rise and a either decline in the stock market or very much just kind of bouncing up and down, staying constantly just going nowhere. I think we've seen that over the last couple of months, and we're seeing a big decline today also. Also talking about equity markets having a decline, and then eventually seeing the Bank of England cut rates, and then seeing some decline in the property market. But the fact remains that there is just not enough housing in the UK, and people need places to live. So I think this is going to bode well for peer-to-peer lending companies that can continue to provide a good, reasonable selection of loans to credit-worthy people. And it's also going to bode well for you as a customer of peer-to-peer lending, as long as some these companies can survive on their current track record of the way that their businesses are set up. Now, we saw a couple of weeks ago, and we talked about this on the stream, where Brian Bartaby of Propland was saying that some businesses in the peer-to-peer sector in their current forms, they think continue to survive that way. Mainly the businesses that are lending to borrowers in tranche formats and with monthly drawdowns, how it just wasn't sustainable. And maybe this is what we're seeing with Assetz Capital, how there's just not enough demand and not enough money coming in, not enough trust on the consumer side. And it's creating, this big imbalance of demand and supply in peer-to-peer lending. And, let's get right into the Assetz Capital story, because I think this is a big one. Obviously, it wasn't really a surprise to me, judging by just looking at my manual lending situation, the loans that are in my manual lending account. And I had talked to Stuart Law about this in a previous interview, saying that, I noticed that a lot of the loans were suspended of trading inside my account, and he addressed that. I'm going to play that for you in a minute. Well, let's just look at this email that they sent out that I received. It says, Lawrence, over the last year, we've seen a final sharp and substantial rise in interest rates, blah, blah, blah. This has led to access accounts and other products becoming less competitive than they were versus rates offered by some bank savings. We recently raised the rates on access accounts and initially saw healthy net inflows of capital. However, after continued bank interest rate rises, retail investors were withdrawing capital on a net weekly basis. I mean, this makes a lot of sense. If you're going to get 4% in Assetz Capital in an access account and you can get 3% in a savings account, I don't think you're going to take that 1% extra risk amount. Give me a second. I'm going to put the dog down because she is causing a little havoc up here. Hang on 1 second. Come on. Oh. It's live. It's what happens live. You want to say hi to her? Say hi. This is Harley, the dog. She likes to get into mischief. Come on. There we go. Okay. So obviously, if you're not getting enough interest on these Assetz Capital accounts, you're going to take your money and put it into what is perceived as safer places. Maybe also peer-to-peer lending companies that maybe don't have as much risk. Assetz Capital is lending to SMEs, small and medium enterprises, which have inherent risk. It's very difficult to lend to businesses and just really figure out how risky that loan is. Assetz Capital is very experienced at doing it, but it does come with some drawbacks. And you as an investor probably not being paid enough as far as what risk goes, even though an access account is giving you a lot more flexibility, so you could expect to get paid a lot less in interest. Problem is, as bank interest rates have gone up, retail investors are pulling their money out. Assetz Capital obviously sees that happening, probably at a growing rate, and has decided, we can't continue to operate our retail side of peer-to-peer lending with this substantial outflow of investor capital. Let's keep going. In our last email, we said we would consider ways to provide our investors with immediate access to higher interest rates provided by our more recent lending activity. Whilst these more recently originated higher interest rate loans, often 7% or more, are available today in the manual lending account, we know that manually selecting loans for investment is not for everyone, And we have not seen high enough levels of demand for those loans. Yeah, here's the problem. If I just look at my own account, having a lot of trading suspended, loans that have run into trouble in the manual lending account, of course it goes to say that people are not going to continue investing in those loans. If they're not performing, they're very difficult to risk assess as an investor, almost impossible unless you've got a lot of experience, and even then, it's not forced to work out. Obviously, people are not going to continue investing in those manual lending accounts. Assetz Capital is seeing that now. We also looked at the potential for a new higher interest automated account or an easy auto invest process applied to the manual lending account. We polled our investors to add this feedback to our thinking on the retail investment side of our business. Unfortunately, we did not see substantial demand for a new higher interest rate account as a result of that poll. We also reviewed the wider market, so there were no substantial levels of new net investments taking place elsewhere in the peer-to-peer lending space. As a result, we have reluctantly made the decision to close the retail platform and conduct a solvent runoff. This is very important. This is not an administration insolvency. This is a solvent runoff of the retail loan book. Assetz Capital will become a 100% institutionally funded lender from now on in order to continue achieving its aim to make finance accessible to borrowers and providing growing and valuable support to the house, building, and care industries. Again, not a surprise. Obviously, the demand isn't there. They need money to continue to run their business. Obviously, institutional lending is a much bigger business than retail. We've seen companies like RateSetter go institution. We've seen a lot of other companies, Lambay, go institutional. And it kind of made sense that Assetz Capital being the size that it is, you're talking over £1 billion of lending, that they're going to eventually become institutional. Now, in past conversations with Stuart, he has always said, no, I continue to plan to support retail lending. Obviously, you cannot always go off what people say. If it doesn't make sense financially on the books, peer-to-peer lending companies are just not going to continue to service retail customers. Kind of like a job, right? If you're working a 9-to-5 job for a company and they say, yeah, we're committed to loyalty to our employees. Fact is, if that business starts to struggle financially, of course, they're going to start to terminate people's employment contracts. No different with peer-to-peer lending. There isn't money there. They're going to close the retail lending doors in search of a better profitability and easier money, which is what institutional funding awards them with. We've notified the FCA of our intentions. Assetz Capital will continue to be authorized. It's been rewarding to have our retail investors earn over £170 million of gross interest over the last 10 years. It is pretty sad because Assetz Capital has been in the business for a long time. I've had a really good relationship with Stuart Law, and it's kind of sad to see that they are going this way, but I, again, totally understand it. Not that I'm happy about it. There's some other things in here that I'm going to talk about, especially the fees, that I think really suck, and the way that Assetz Capital has handled their access account in some ways I think is going to piss off a lot of people. But, it's still sad to see that they are closing their door to retail investing. Our other business aims to remain just as strong for expansion in 2023. A couple of important points. The platform will continue to operate for existing investors. You will be able to access information regarding your account. We will continue to monitor and manage your loans, collect interest, and return capital over time as loans redeem. We'll continue to pursue recoveries on your behalf. So that's any loans that are in bad status. We remain committed to providing investors with an appropriate level of service through the runoff period. No, don't deposit any new money. That's really important to know because you're not going to get any investment on it. Spare cash in any investments accounts will be moved out to your cash account automatically. All loans are repaid or interest is received. The cash will be moved to your cash account for withdrawal. So you want to take out any cash that's inside of your cash accounts in Assetz Capital now. I think that kind of goes goes without saying. Don't set up any new ISAs. Obviously, customers with an existing ISA should take care to preserve the tax status of their ISA by arranging a transfer out rather than withdrawing funds to their bank account. Very, very important to know. If you sell out of your investments in an ISA and then take the money back, it can affect the tax wrapper on your ISA. So what you want to do is transfer that ISA out of Assetz Capital to another company. It's very important to know that. All buy and sell orders on the manual lending account have been deleted. There is no new trading that's possible. The access accounts have ceased to trade, and a detailed explanation is below. Capital will be returned to you as quickly as possible, and interest will be provided in the usual way. And now this is the one that's going to piss everybody off. A lender fee is going to be charged again to cover costs of the running off of the loan book without the benefit of any new lending income from retail funds. Yeah, I mean, what can you say about that, right? If you're getting 4% potential interest on an access account, and now they're going to start charging fees on that, you're just really not going to make too much money after tax in a taxable account over the next period of X amount of years. That really, really sucks. Let's see. This is kind of a long email. So the target rate on the quick access account is going to continue to be 4% a year. We do not expect withdrawals to commence before these notice periods expire, so that everybody will be treated in the same way. We expect access account investors will be able to withdraw capital from redemption starting in approximately 6 months. So what they're going to do is continue to run off the loans, and eventually after a certain period of months, providing that the loans perform, you're going to be able to start withdrawing your money in approximately 6 months of timeline. Whether or not that is an accurate timeline really remains to be seen. We've seen in the past these target timelines don't really, they rarely ever get met, but we'll see. Hopefully Assetz will be able to meet that timeline. In the manual lending account, no other loans or new loans will be provided, so that's pretty much going to be a non-existent product anymore. Once loans redeem and repay capital partly or pay interest, the cash will be transferred to your cash account. We expect manual account investors will be able to withdraw capital from this month onwards. So that's faster than the access account. Lender fees, here we go. Let's talk about this nasty bit of news. The ceasing of new retail lending means a significant drop in our income, blah, blah, blah. It means that they need to make extra money because they've got a large overhead of staff members that they need to pay. And unfortunately, us investors are going to pay the price for that. So this is fees that are going to be charged to us as investors through to the end of June 2023, 2.9% per year interest on performing loan. And then from July to December, 1.4% of performing loans per year interest. January 2024 onwards, 0.9% per year is the fee that is going to be charged on these loans. So really the nasty part here now through the end of 2023. Unfortunately, this is what happens. We don't really have any control over what companies can charge when it comes to fees. Finance companies do it all the time. They change their fees when they need to. If they're looking at their business models, thinking this is what we're going to need to continue to be able to operate this loan book and make sure everybody gets paid back, this is what we think we're going to need to charge. I don't know where they come up with these numbers. What I'd like to do actually is reach out to Stuart to get him on the stream in January and have him really explain what's going on with Assetz if he's willing to do that. Stuart, if you're watching, please come be a guest on the stream so we can talk to you more about this. I get both sides of the coin on this fee situation. Number one, your goal as an investor is to get your capital back without losses. At this point, when a company is closing its retail doors, capital preservation is everything. Who gives a crap about 3 or 4% interest? Personally, we just want to see us get our capital back. If we make some interest on top of that, great. If not, I'm not worried about it. 3 or 4 or 5% isn't going to really be a game changer unless you're talking about huge amounts of money. So I get that what they're trying to do. I don't like it. Of course, nobody ever likes lender fees. I'm always talking about this. Fees are the root of, eroding returns for everybody. We talk about that in index trackers, why we love them, because they're low fees. And 2.9% a year for the first half of the year is going to hurt. It sucks, but it just is what it is. But I understand it. Doesn't mean I like it. This equates to an average fee of 2.15% for the first year and a 5% effective fee of 1.15% per year. These are estimated and subject to review over the time. That could mean they could go up, or also they could go down. That's at the discretion of Assetz Capital. Other matters, there is going to be a online Q&A tab that they will no longer have, so that will cease. Detailed and high-frequency lender updates on individual loans and detailed stage drawdown credit reports will cease. Less frequent and briefer event loan-driven updates will be provided, so it sounds like the communication is going to become worse. The circumstances in which a lender vote is issued will be reduced. Capital value calculations will cease as loan trading has ceased. See here. There's a page too if you want to read more about that. Thank you for understanding and being a customer of Assetz Capital for the last 10 years. If you have any questions, you can contact their investor team on 0800 470 0430, option 1 via live chat or via email. So, not the news that everybody wants to hear, but it's better than the alternative, which, we've seen with some of the other companies that have gone into administration. It's not the best case scenario. It's also not the worst. The last thing you want to see is we're going into administration because we can't continue to operate our business profitably. Seems like Assetz Capital has a good line on funding institutionally, and that they see that as a more viable business proposition for their company, so they're transitioning into that, basically closing the door on new investments, closing the door on offering new loans to retail investors, and running off the loan book, as we've seen with LendingWorks is doing that right now, which seems to be going okay. And we just hope that those loans will continue to perform and that people will get their capital and interest back. This is, I think, important that we look through to 2023 as being actually a really positive year for peer-to-peer lending, as we kind of clear out these companies that are no longer able to financially serve retail investors, for there to be less options for people to invest in, but better quality options. I kind of see this as a positive thing. I wasn't really happy with the way that Assetz Capital was performing. I talked about this on the stream with my own loan book. Just too many loans that were in trouble. So again, Assetz Capital has to move on. I generally see that as a good move for them. Let's talk about Assetz Exchange. Obviously, they have a connection to Assetz Capital. I mean, they got the same logo. So I'm sure it's going to be affecting them also. Here's the announcement from them, from Peter Reed. Following today's announcement from Assetz Capital, they are closing their retail platform. We'd like to ensure investors that we will continue to welcome retail investors to the Assetz Exchange platform. Assetz Exchange is a standalone company with an independent management and no crossover of staff. All of our properties are 100% funded by retail investors, and we remain resolute in our mission to provide a source of regular, stable, inflation-linked income for investors. Our business model means the logistics of managing a large retail investor base is simple. We are not fielding a large number of customer inquiries, as we do not have borrowers to chase for payment, and the underlying assets remain under investor control. We are extremely proud of the platform we have built and appreciate your loyalty and encouragement we receive from you. Now, this is going to obviously affect Assetz Exchange, number one, because their name is linked to Assetz Capital. But it seems like this is really not going to affect their business model, because Assetz Exchange is very much independent of Assetz Capital, even though they do share that Assetz name with a Z at the end. I don't foresee any problems as far as I can tell with their business at the moment. It seems like everything is just going to proceed forward. It's kind of a shame for them, though, to be caught in the backwash of Assetz Capital and this big news that they have announced to us. But I think everything is going to continue as normal. How long we've been going for? Half an hour. If you have comments and questions, pop them in the chat. We'll do a quick Q&A at the end. Here's a little LoanPad update. We are providing a brief monthly update and a recap of the year so far. There is little to report on the loan portfolio, and all loans remain in good standing. We have welcomed a new 10th lending partner to our panel. I've reached out to Louis to find out who this is. I just haven't heard back yet. We are looking forward to a long-lasting partnership with them. Generally, when LoanPad brings on a loan partner, it's somebody that they vetted very well and that they're extremely comfortable with. So, it's not they don't open the door to everybody. So it'll be interesting to see who that 10th person is. This year, we have seen solid growth and also various challenges, not least a rising interest rate environment for the first time in over 10 years. We believe our model has proven itself through the pandemic and is now proving itself again through this increasing interest rate environment. LoanPad was built with the need for flexibility in mind and in a manner which therefore enables us to adapt quickly to changes in the market. All loans are short-term, average term of less than 1 year, and this ensures a relatively reliable flow of loan redemptions each month. In this turn, this enables us to have regular liquidity to meet withdrawals, and very importantly, to change interest rates on our accounts in order to remain competitive. We have recently moved many new loans into variable rates, which will shortly enable us to act more swiftly as interest rates change. LoanPad's interest rates are due to increase in January and February of 2023, and we'll provide a further update on our interest rates in due course. This year has seen solid growth for around 60% in the size of the portfolio, increasing all investors' diversification. This includes diversification across lending partners and loans, and we could anticipate this will continue into 2023. It's important for us to express how grateful we are and your support and trust. So, LoanPad continuing to grow, continues to do the same thing. I love the way they're able to just change. They're very liquid. I think of LoanPad like water. They're able to navigate through these interest rate increased waters very easily, something that a lot of other companies are not able to do because they're locked into longer loan terms, and they certainly don't have variable interest rates, which I think is really smart. It's a really smart thing of LoanPad to do. Bank of England has put the interest rates up again to 3.5% from 3%. We saw it happen in the US. So it's important for LoanPad to be able to move with these changes, which they're perfectly set up to do that. So good job on LoanPad for doing that. Let's talk a bit about Property Partner. They have been doing an equity fundraise that has been going, I would say, mediocrely. I checked on their platform and I saw that some of the properties are just not getting funded because, again, people are going to want to throw money into a investment that's not been returning them anything for the last several years. No, of course not. So what they have done is canceled some of those properties that they saw were not going to get funded, so people could move money that they wanted to invest into the other properties, which would give them those other properties a chance to get funded. Then they send out this announcement. We're excited to announce a program of a direct investment of $2.4 million into the resale market of our parent company, Better. The founding principle of Property Partner is to deliver genuine liquidity to an otherwise illiquid asset class. That's property. The resale market is the beating heart of Property Partner. Better's direct investment will lead to increased liquidity, encouraging efficient pricing and assets valuations across the portfolio. This investment will commence on the 1st of February 2023 and continue for 3 months. Better's investment in any property will be limited to a cumulative maximum stake of 10%. What I see this has come from is obviously the lack of people wanting to put money into Property Partners marketplace. And Property Partner acts quickly and said we need to find money to invest into the secondary resale market because we need to remain liquid. People are going to want to sell and buy. Who knows what's going on over there, but if there isn't any liquidity to sell, it creates a problem. So, that's just a result of what's been going on with property partner. I just don't think it's been a very good investment, and people are probably wanting to get out of there in some form. So, yes, what else? We got easymoney.com has put their interest rates up now, as we talked about this, and before you can get starting at £100 investment 4.53% all the way up to 6.51% target rate. This is still a little better than what you're going to be able to get in savings accounts. 4.53% is not bad. But Loan Pad is going to follow suit and kind of follow these rates, so that's good news on that take. So let's take a look at some clips here of some of the peer-to-peer lending interviews that we've had over the last year on the Financial Think channel. I've been lucky enough to have these guests, CEOs of these companies, these peer-to-peer companies we invest in. And these are some of the questions that I asked that I thought were really interesting. I'm just going to go through and let you hear just a snippet and then kind of talk about them a little bit. So we're going to start off with Axia Funders Q&A that we did with CEO Cormac Leach. This was about 11 months ago. I don't like the way that YouTube doesn't put the dates anymore. So January 13th, 2022. There you go. If you hover over it, it shows you right here. Boom. So let's see what Mr. Cormac Leach had to say. And so what is Axia's biggest challenge for the business for you right now?
So we have constantly changing kind of top priority in terms of issues we're trying to solve. I would say right now I think the top priority for us is actually to find those high net worth and professional investors that are willing to come in and increase our firepower, if I can put it like that, so that we can consistently fund those £500,000 or £600,000 cases instead of currently we can relatively comfortably fund cases that need 250 or 300,000. But it would be nice if we could find an extra pocket of capital, and it's just something we haven't really had time to focus on.
So this is something that peer-to-peer lending companies face all the time. It's the demand and supply, having enough money coming in to fund all of the deals that they're putting out on the marketplace. And again, one of the reasons why Assetz Capital is closing its doors to retail, because it wants to have institutional money. It knows it has enough to fund all of the deals that were coming through. That was a really good chat with Axia Funding. If you haven't seen that Q&A, I would definitely go and check it out. That was from January 2022. Let's go ahead and move on. Here we got Mr. Shojin, property partner, Mr. Jatin Ondia. This was in March of 2022. Let's see what his interesting answers. One of my questions was that I really got a lot out of. So do you personally invest in peer-to-peer lending yourself in other companies or other peer-to-peer lending? Did you do any due diligence that way?
Well, when we started Shojin, so really the way it happened was, because I was always invested in real estate, the way we launched Shojin wasn't actually starting with peer-to-peer, because we'd always, myself and my co-founder, we'd always invested in real estate, and a lot of people we were surrounded by in not just banking circles but professional circles generally. A lot of people were kind of listening to the kind of things we were doing in the property space, and it was really easy stuff, like basically buying rental properties and things for student lets. But people loved the idea of it. But when we told them how easy it was to do it, you realize a lot of people didn't have the time nor inclination to do it for themselves. And you realize, people are busy with their own lives, and they've got to stay focused on that. They're very smart in their field, and a lot of people don't really want to venture outside of that. But a lot of people started asking us if they could invest alongside us in the things we were doing. And that's really what started Shojin.
So pretty interesting. Shojin, was never started as a peer-to-peer lending company. I think it just morphed into that, which is generally how these businesses are created. They see a demand out there that's not being met, and people want to invest in certain sectors that they can't get into, probably due to lack of capital. So Shojin was able to create this peer-to-peer lending company just purely out of demand. So I thought that was really interesting. Here we have Rishi Zaveri from Lendwise. I know some of you invest in Lendwise. I asked him about cryptocurrency. I thought this was pretty cool. Let me ask you about, you're a finance guy, and we talk a lot about cryptocurrency, just to get off topic for a second. Are you a fan? Not a fan? What do you think?
I'm intrigued. I'm a fan in that I'm interested to sort of see what happens. I don't, but I'm balanced. Yeah. So I'm kind of, I have the same questions. I wonder, and I think, it's a very broad topic, right? And actually, I think what we see now, or what we think now as crypto, probably isn't how it'll end up, right?
I love that answer. I've been saying this for a while. Remember when the internet first came out? Some of you out there will remember that. What the internet was at the beginning is not what it's like today. Things are going to evolve. Technology evolves. Use cases evolve. And I think Rishi and I were on the same page about that. That's the way I've always felt, that we're very early in cryptocurrency, despite all of the problems, kind of like peer-to-peer lending went through. Just this really difficult stage where a lot of companies were going out of business. We had some bad apples in there. But then peer-to-peer has kind of evolved into, I think, a more stable place and a more stable sector. And I think this is going to happen with cryptocurrency. Next, we got Assetz Capital, quite fittingly, Stuart Law. Let's see what he has to say. So this is always a difficult one, but I've noticed in my own account in the manual lending from some of these older loans that a lot of them are under trading suspensions right now. And I know people in the stream are asking me the same thing, like what's going on? Why are there so many loans that are suspended at the moment? Can you give us an uptake on that and what's being done to sort those out?
Yeah, there's two different factors. So one factor would be, quite simply, any loans that are having a little bit of slow speed being picked up in terms of repaying on time, etc., or any noise, those would tend to be the loans more that were in the access accounts as we ran them down a bit. But actually the real reason is the hair trigger approach. Suspension isn't default, and suspension isn't necessarily loss either, or even an expected loss. Suspension is about not necessarily knowing that we know for certain the answer, because under the FCA regulations, we have to permit fair pricing of a loan. And the second we get any kind of feedback that means we may not be certain of the current situation, then we're going to get into hair trigger, press of the button.
Very, very interesting. And it actually makes a lot of sense to me when we see loans that were suspended trading on the Assetz Capital platform. If you don't really understand how that system works, you're going to automatically decide, well, those loans are obviously in trouble. Now, some of them are. Let's not pull any punches here. But the way the FCA has set things up with their tighter requirements, it means that things can get hair triggered a lot easier now when loans, maybe they go a little bit past due, or whether a company within the peer-to-peer space doesn't quite know what exactly is going on with that loan, they go ahead and suspend trading. So I thought that was a pretty interesting answer. Let's go on to Landlord Invest. Here we have Philip Karadagi. He is from Landlord Invest. Let's see what he has to say. Speaking of that, Philip, because we've had these platform failures and we get new people that come on this channel or who email me saying, how can I know which peer-to-peer lending companies are safe or relatively safe for me to invest in, because so many of them have gone out of business? What kind of tips could you give or advice for people screening, which companies are okay to invest in? By the way, Philip did not want to appear on camera, hence his photo. Which ones you probably want to be wary of?
Sure, it's a very good question, and it's very relevant as well, given the failures of the platforms in the UK. I mean, it's one of the first things. For example, Lendy, looking at Lendy, which I know a lot of people probably listening into were invested to, and you too. I mean, it's all I want to say in that aspect. For example, I logged into Lendy once and just to have a look around and obviously see what they're doing and see what, trying to maybe learn something from them as well. I mean, like every other platform does. And I went to one of the loans, which was the one on Asia Road in London. It was quite a big loan, 8 million or thereabouts. And I just read the description, download the valuation report just to be interested and see how they do it. And I didn't have much confidence in the materials and everything that was provided, but it felt to me that once again, given my background from finance, which probably helped in that aspect, it just didn't fill me up with a lot of confidence.
So a really interesting take that we see the CEO of Landlord Invest who went in and checked out these Lendy documents, and he said, I just didn't have a lot of confidence in what they had provided there. So pretty interesting. Turned out Philip was completely right. Let's go here to our old friend Louis Schwartz, and obviously not that old, but we had him on the live stream on November 3rd. Let's see what Louis had to say. I have to ask you, so I didn't put this into our discussion before, but what do you think about the current peer-to-peer market in general? Do you think you see positive things going on? We don't really see a lot of new players coming into the market, obviously with these FCA tightening of the screws. We've got these removal, I think, in January of the paid incentives. The peer-to-peer companies are not going to be able to offer things like cashback, which I presume LoanPad will end that, correct, in January? You see that LoanPad, these auto-generated closed captions sometimes can be funny. January, or is that changing? Is that coming on?
No, yes, absolutely. Yeah, we have to end any bonuses as well.
When does that end? Is that January 4th?
I'm not sure the exact date. I think it's actually next month. I think it's in December at some
December.
point.
Okay, so yeah, if you want to get your bonus and sign out, you better do it now, because that's going to be going away soon. So what are your general take on what you're seeing going on in the peer-to-peer sector? Has it been a positive take for you?
Well, I think, as you say, it's a lot quieter than it was, 3 or 4 years ago, with a lot of companies having exited or closed down for one reason or another. There are, I think, other very good P2P platforms around, and although we're competitors in one sense, I think really we're fighting the same cause. Essentially, we all want peer-to-peer to grow, and if LoanPad brings an investor into peer-to-peer, there's no reason that investor won't diversify into other platforms as well. So we very much support other P2P platforms. We want to see them do well. Mm-hmm. And yeah, we'll keep doing what we can do. But
am I allowed to ask you who you like and who you think is doing a good job, or is that going to be something that you're going to plead the Fifth Amendment of the U.S. Constitution?
I'll be scared not to mention certain platforms. So yeah, all of them. I think they're all doing a good job. If they're still in business, I think they're all doing a good job.
That's a big positive thing to say there by Louis at LoanPad. He thinks they're all doing a good job. I wonder if he included Assetz Capital in that when he decided to say that. We got Peter Reed here of Assetz Exchange. This is June 30th of 2022. Talk to me about your relationship with Assetz Capital. Are you guys still working together in some capacity, or is it more things have changed?
Yeah, very much so. So, I mean, the common denominator is Stuart. So Stuart's the Stuart Law. He's the chairman of Assetz Exchange. He's the chief executive officer of Assetz Capital. He's the largest shareholder in both businesses, and so it is great. We've been able to say, Stuart, we need help in this, and he's been able to say to people in Assetz Capital, please, can you help out? And that's been tremendous help. We are legally, regulatory, completely separate companies. They are our living will provider, so as we were to go into a wind down situation, they would step in and look after us and wind down the book or take over us and invest in us and whatever they decided to do. And they are a shareholder in ours, a small shareholder, and that's that shareholding represents the living will provision that they provide.
Very interesting. We saw from that email that they sent out the update saying that Assetz Capital changing or closure of the retail side of lending would not affect Assetz Exchange. But as you heard there, obviously Stuart Law, who is the CEO of Assetz Capital, is one of the shareholders is in Assetz Exchange. So hopefully it will not affect the way Assetz Exchange continues to operate, because I think Assetz Capital as a business will continue to operate just in a very different form in the future. Here we have George Huntley. This was from 2 months ago. So let's see when. September 22nd, 2022. George Huntley of the Money Platform. Let's see what he has to say.
Sure. Yeah. So this is to be really clear with everyone listening. This is, unsecured consumer credit. And
I had asked him, by the way, how do you get money back from people that don't pay?
Lots of lenders who I've spoken to have kind of old-fashioned ideas about what we can do. We certainly can't go and seize people's property or anything like this. It really is unsecured. So the main things that you can do are you can take them to court and get a CCJ. We don't do that because it doesn't work. In summary, it doesn't. If the person's not going to repay after you've sent them a default notice, they're no more likely to pay once you've defaulted them in the court. So it doesn't work. It costs a lot of money, and it doesn't work. What we do is we mark their credit report as defaulted, and it's worth stating very clearly they don't have that when they apply to us. So none of these people are defaulted. We never would accept someone who's got either a CCJ or a default on their credit file, because it shows that they've got no real intention of repaying.
So what George is saying, basically unsecured lending, they try to get borrowers who have good, clean track records, and if necessary, they have to try to collect money that is not being repaid. They basically put a dent on their credit report, which is pretty much the way that most unsecured credit companies work, and then they would probably either sell that debt to a debt collection company who would try to collect and go from there. Let's skip over that one. We've got finally my pal Tim Robinson, who is just actually a guy who I'd met in London in December of 2021, who desperately needed help with his investing roadmap, and I had him on the stream. This was back in February 12th of 2022, so about 10 months ago, and a very interesting question that was asked to him. But so Zero, how would you say your financial health is right now in general? How's your spending and your saving going? Have you been able to save money?
So my financial health it's almost like just starting to wake up financially. I think a lot of people in my industry, PTs or online in the fitness sector, it's
personal trainers.
They're very, very focused on earning a certain amount each month, and that's like their goal. But in terms of how they allocate those finances, that's not really something they pay attention to. So it's something I've become increasingly more mindful of. But I definitely, I've focused on finance. I typically tend to focus on finances a lot at the start of the year, a lot on really getting my business going, and then I tend to basically enjoy the summer and forget money exists as a thing in this world.
So yeah, I've been working with Tim now for about 10 months, and I can tell you he has made some amazing changes in his life. I would say he's completely turned his financial life around. He's become very much aware of what he's spending. He is working on building up a emergency cash cushion, which he's very close to achieving. And I think it's very, really fulfilling to see somebody like that who just had no real grasp and no grasp on his finances and no idea how to invest, to come so far in just a period of 10 months. And, I would say that about 3 months into working with Tim was when he really started to turn it around. So going back and listening to that interview from February is just a really fulfilling thing to hear how far he has come. We're going to get Tim back on here too. By the way, if you need a good fitness trainer here in London, you want to get ripped, go to Instagram, search for Tim Robinson Coaching. Great guy. So let's talk about, that again in summary is just some of the really interesting Q&A sessions that I've had over the last period of a year in 2022. They're very difficult to put together. You're getting people to come and commit to doing these streams. So I'm really thankful to those people that did show up to do these Q&As. Thank you so much out there for doing it. And I know we get a ton of value. We get to learn a lot from these CEOs, and I always try to get the CEOs, which again, it's not easy to do. But go back and check out some of the archives if you haven't watched them, because there's some just amazing information. Even if you want to go back and watch Stuart Law's Assetz Capital Q&A, I think that's very, very insightful. I'm going to run through real quick because we've been going almost an hour. We have to look at the CPI. This is the inflation print, which I think gives us a little bit of a forward look into what we're going to see in the UK. We saw a pretty nasty report of a 7.1% inflation rate, which had risen year over year from November in 2021, 0.1%. So while people are saying, well, the inflation rate in the US has gone down from 7.7 the previous month's CPI report down to 7.1. If you think about that, 7.1 is still a very, very high inflation rate, and how quickly this starts to subside, I'm not convinced. And I think putting the interest rates up like the US Fed and the Bank of England is doing is really only putting a hurt on just consumers. It's not necessarily solving the inflation problem. If you are on adjustable rate mortgages in the UK, you're going to see your mortgage payments have gotten higher. It's going to really put a lot of people in a lot of trouble, and it's very much a shame. Trading 212 portfolio has been very negatively affected by what's going on in the markets. I know you've seen some drops. The FTSE had its worst day in 2 months after the Bank of England rate hike, which was reported on December the 15th. FTSE was down 0.9% on that day. Is that today? That's today, actually. So yes, the stock markets are just really struggling at the moment. And you can see here the 212 portfolio. We really want this to succeed because I really desperately wanted to make another donation to charity, but we have just not been faring very well. We're almost down from a 19,700 high, now down to 16,988. So we see some of these stocks in here, just generally stocks across the board have really taken a beating. We've got Synovus just in the red, Deutsche Bank in the red, Flex natural gas has been the one bright spark in this portfolio, up about 42%. But you can see here Calera down 17%, Norwegian Cruise Lines down 13%, Vermilion Energy down 13%, Walt Disney down 12%, and then Zim Integrated Shipping down 28%. I think this is just across the board. You've seen what's been going on with Tesla. Just tech has taken a beating, and this is how difficult it is to pick individual stocks if you're a stock picker. If I go to my watch list over here, this is one of the really big disasters of the year, which thankfully I did not put too much money into, but Sphere 3D, which is a carbon neutral Bitcoin company, is down 90% over the past year. But if you look at the S&P 500 tracker fund over the last year, you're only down 8.79%. So compared to some of these other more high-risk, high-octane energy stock plays, and this DNA Bioworks stock down 37%. This is why I always preach, if you're not an experienced investor, and I certainly would consider myself more experienced than most, but even if you're buying blue chip shares like Walt Disney down 12%, you're better off just being sticking yourself in a tracker fund and not going through these high octane volatility plays on some of these, stocks that have done really well in the past are going to take big hits as the market starts to decline, which I personally believe it will in the future. We see the exchange rate here of the UK and the US dollar, which has again been extremely volatile, dropping down here all the way down to about 1.06. Now we're up into the 120 range. So there's crazy volatility in the foreign exchange rate between the dollar and the pound. And even some safe havens, like what I would consider gold to be a bit of a safe haven, has struggled. We've seen a high of 191 US dollars in this fund, back down to 165. But if you look a year on year, you're only talking about basically flat. So not such a bad place, possibly a safe haven to go when things are difficult. But I think we're just going to have a very difficult year in 2023 going forward. So, plan accordingly. A recession is here. I don't think it's going to ease up in 2023, not to be all doom and gloom. There are going to be some really big opportunities out there. If you have some dry powder, they say, on the sidelines, you have cash, you're going to be able to find opportunities. And if you look, we're still pretty high. If we look even from our March 2022 dip amount, we're still up much higher than that. So this was down in the 38 pound range on this S&P 500 ETF. So it's done really well. But once this starts to track back down, as I think it will in 2023, you're going to have some opportunities if you have cash to really buy some very, very heavily discounted investments like, index trackers and ETFs and stuff like that. So just be prepared, and I think we're all going to be okay. That was a lot of information today. I wanted to give you a lot of value for the last stream of 2022. We've been going for about an hour. If you can, please hit that thumbs up if you enjoyed the stream. And remember, yes, it seems like a lot of doom and gloom, but there is a lot of bright spots out there where you are going to be able to take a lot of opportunities. This is the time when really money is made. When things are bad, everybody's running for the hills. It's the time when you can go in and find some really bright spots in the investment world, the peer-to-peer lending in stocks, cryptocurrency and things like that, Bitcoin, which I'm still a big believer in. So I hope you enjoyed the stream. I'm just going to run through the comments very quickly, and then I'll probably bid you a farewell. Assetz appears to be lending long and borrowing short. Hi, Steve E. Nice to see you. Why the service charge when they are profitable, Norman P? That's a good question. We don't really know what goes on in the back. These companies, their positions can change very quickly. If you have a very large staff headcount and a lot of expenses, and you see things starting to change, maybe the environment starting to change, maybe your expenses have gone up, things are getting more expensive. Think about that with inflation. You could start to pivot and say, well, these fees are, to help us continue to operate. It could, again, just be pure greed. We don't know. We don't know what goes on behind closed doors. Steve says he's glad he got out of Assetz Capital when he saw all the defaults. Very smart. Paul says he'd like to know how much Stuart Law is involved with Assetz Exchange. I wonder that too. I'm going to ask Pete to read that. WH is here. Good evening from a freezing cold Essex. I'm interested in the money platform. I'd like to confirm if you loaned any money out with them. No, I have not loaned any money out with the money platform, so I cannot comment from personal experience. A lot of people here saying they are offloading at large Assetz Capital amounts. Yes, there's going to be a lot of pissed off people. Any thought on the mass withdrawals from Binance? Yes, it's natural. There's a lot of fear in the cryptocurrency space. Platforms have been having problems. There's really I would say only two platforms now that are the main big ones. Of course, you've got Coinbase that says they have one-to-one liquidity. So if somebody has just say a pound of Bitcoin, that they have a pound to be able to sell that. So the liquidity is one-to-one, but there's no way to verify that. It's very difficult. So, this whole thing about not your keys, not your crypto, people are withdrawing from these platforms because they don't want to suffer another FTX fate where if for some reason Binance has not been honest and not been showing us really what's going on, they could lose their money. That's why I always say put your assets on a external wallet that you can control. Dave says, you ought to spend a little more time looking at company fundamentals when picking individual shares. I certainly do spend time. I don't always get it right. ASML share was a referral bonus. Thank you, Mike, for signing up. Yes, they gave me an ASML share for that. I appreciate anybody that signed up through the referral link. Legal in General still paying a steady growth dividend. Yes, I know. The price has also been pretty volatile. When is your birthday, Lawrence? January 22nd. I'm not going to tell you the year because I don't want to show off my age. Annabelle is very pissed off with Assetz Capital, bad behavior, especially the charges on top of closure. Yeah, I'm right there with you. I totally understand. It's annoying. It is what it is. We just come to accept that when we make an investment, there's certain things that companies can do with, they have their own ways of handling things, and they can make changes as they see fit. No different than when you invest in a stock or a share and a company CEO decides to make some wacky change that causes the stock price to go crazy, drop or go up. We just don't have any control over the inner workings. That is actually why I like Bitcoin, funnily enough, because there's no CEO to cock things up. It's based on demand and supply. So it is what it is, and we just have to face that part of the risk of when we're investing. So through the good and the bad. But anyway, I think I'm going to get out of here. So everybody, years younger. I'm 49. Okay, there you go. Everybody have a wonderful Christmas holiday and spend it with your family. I hope you have an amazing time. I hope the weather's nice when I come over. I'll be back soon enough. And again, much love to every single person that's been here, supporting the streams over the last few years, supporting the channel, supporting the Financial Thing website. Things are going to change in 2023, whether we like it or not. And we just roll with it. We change. We become financial chameleons. We have to bob and weave, as they say in the boxing world. So, but much love to you guys. Have a great Christmas. Have a great New Year's. Maybe I'll see you on New Year's Day. And much love to you. I'll see you in 2023. Take care. Merry Christmas. See ya.